Hello there, my name is Randy Helm. How are you doing today? I'm doing well, thank you for asking. Today's topic is on fixed assets and depreciation. Now, this is a big topic, and I'm sure there will be questions when we're done here. The goal here is to cover the main points so you get an understanding of the gist of what's going on. We're not here to turn you into an accountant, and in fact, you will probably still need help from your accountant or tax preparer when we're all done with this. But don't worry, that's perfectly normal. So if you're ready, let's begin. Fixed assets can also be called long-lived assets or property, plant, and equipment. These are different labels that mean the same thing. So you may be asking yourself, what is a fixed asset and why should I even care? Well, when you purchase an expensive item for your business, you would like to receive a tax deduction for it right away. But guess what? You can't. You have to spread it over several years. Those are the rules. Well, who made this rule? Well, for tax purposes, the IRS made this rule. For generally accepted accounting principles, the Financial Accounting Standards Board, or FASB, made this rule. Now, when you spread the costs over several years, you have an amount sitting on your balance sheet. This amount is the book value, the value of the asset that shows up on your books. Over a period of time, you will show a depreciation expense and reduce the book value of the asset. Today we're going to talk about which expenses require this treatment, how long you spread it over, and what that really looks like. Here are some examples of things that would be considered fixed assets. Buildings, trucks, tractors, tanning beds, walk-in coolers, cash registers. A lot of stuff that ends up costing some bigger dollars. What does not count as fixed assets? Things like inventory for sale to your customers, office supplies such as paper and toner, pens and pencils, utilities, shirts with your company logos on them, stuff like that. The main criteria for a charge to be classified as a fixed asset are as follows. It must be property that you own. Leased assets do not count. The property must be actively used in your business. It is not personal property that you use for leisure or just normal living. It must be for business. And it is not something that is sitting idle. Imagine if you owned a vacant building and it had no tenants. You bought it with the idea that you might lease it out one day or you might flip it. Since it is not active, it doesn't count. It must have a determinable useful life. Except for land, I can't imagine an asset that doesn't have a useful life. You may not know how long the item is going to last, but there are probably statistics somewhere that would indicate a useful life. For this, a reasonable guess usually is good enough. And it is expected to last more than 1 year. If it is expected to last only a few months, it should be just expensed. Is there a dollar threshold that you need to be aware of? Well, yes, there is. The set minimum can vary from company to company, but most set it at either $2,500 or $5,000. These are amounts suggested by the IRS. So hey, that works for me. Some folks have a tendency to want to expense everything and not book fixed assets. One of the problems is that your tax preparer might not go for that. Another problem is that you may see a lower net income in the short term. If you are regularly showing your financials to your banker, this might present a problem. Your banker might think you are not performing as well as you think you are, so you need to have a good balance. Now let's pause a moment. Here is the basic fixed asset process. You purchase the item, you decide if it should be considered a fixed asset or if you should expense it. And at this phase, you should consider the characteristics of fixed assets that we have already stated. You need to determine a useful life. If you have purchased similar things in the past, you will likely use the same life for this new asset. Then you will start depreciating it. This is the slow and systematic way of reducing the balance over several years. This is a process required by the IRS. They will not let you take the tax deduction in full in the year that you purchased the fixed asset. This process is also required by FASB, as we stated earlier. Now, you may choose to record depreciation just at the end of the year, or you may choose to record it monthly. My preference is to do it monthly. This helps you to remember that it is there each time you look at your monthly reports. This will lower your net income. If you don't see the depreciation for most of the year, you may forget about it and think you are doing much better than you really are. If you have an outside accountant or tax preparer compute this for you annually, you could still record your best estimate monthly, then adjust the final amount in the last month of the year. After you have been reporting and depreciating fixed assets for a while, this is how it might look on your balance sheet. You will have one line, or maybe a few lines, that represent the original cost of the assets. Here we are showing 3 lines with the original costs. Then you will show how much depreciation you have reported so far. This is the line accumulated depreciation. When you subtract the accumulated depreciation from the previous lines, you land at the current book value of all of your fixed assets. The income statement will just show one line for depreciation expense. Each month, or annual if that's when you record it, the depreciation looks something like this. The depreciation expense account is charged with the amount, and the accumulated depreciation is increased by the same amount. The accumulated depreciation account sits in the asset section on the balance sheet, but it has a negative balance. This reduces the net amount of the assets. The accumulated depreciation grows each year and does not reduce until you sell some of the assets. The depreciation expense will reduce your net income. To better show you, suppose you purchased a $7,000 asset and recorded your first year's depreciation of $1,548. The entry would look something like this. And this is how it would look on the balance sheet. And this is how it would look on the income statement. If you would like a refresher on the income statement or the balance sheet, please check out my other videos on those topics. So a question had come up. Someone asked me, if it's not listed in the balance sheet, does that mean that it's worthless? And the answer is no, no, no. Emphatically no. The value of your company is not exactly what the balance sheet shows. Try not to tie those too closely together. There will be a relationship between the balance sheet and your company's worth, but it is not that tight of a relationship. There may be several things that do not show up on the balance sheet that do add value to your company, such as the amount of small supplies on hand that are expensed, your brand name recognition in your area and industry, the location of your facility, and of course, your great team members that you have employed there. And you may have noticed that land was listed in the example of what may show up on the balance sheet. And you might be wondering, do you depreciate land? Again, the answer is no, never. Although it is listed in the area of fixed assets, it does not get depreciated at all. Once you buy the land, it stays on your balance sheet at that same value until you sell it. If you make some improvements such as adding a parking lot or planting a lot of trees and bushes, that can be depreciated as improvements. But the original land stays undepreciated. Now let's discuss the useful lives. The IRS does provide a lot of guidance on this. I will present some of the more common ones, but just know that there are a lot more rules and guidance than what I am presenting. For a detailed listing, you can go to the IRS website and review their documentation. I present the link here on the screen and down below in the description. There are not a lot of assets in the 3-year category. Here are some of them. The depreciation schedule is based on depreciating these assets over 3 years. These are some of the items that can be classified as 5-year property. That means the depreciation schedule is based on a 5-year life. Over the course of that time, the asset will be fully depreciated. In this list, the most common ones that I have seen are autos, trucks, office machinery, and stuff for residential property, such as apartment buildings and duplexes. This stuff would include refrigerators, ovens, furniture, and things like that. These are some of the items that can be classified as 7-year property. In this list, the most common ones that I have seen are office furniture. You may have some of these others, and that's fine. I have not seen these personally. These are some of the items that can be classified as 15-year property. The depreciation schedule is based on a 15-year life. In this list, the most common ones that I have seen are the various improvements to the land. I mentioned earlier that the land itself cannot be depreciated, but improvements can. If you own residential rental real estate, such as an apartment building, you need to use a 27.5-year life. If you own non-residential rental real estate, such as a strip mall, you need to use a 31.5-year life. We discussed different asset lives. For the purpose of depreciating the assets, there is another concept I should mention. When you start the depreciation schedule, it is normal to use a special timing convention, such as a half-year or a mid-quarter or a mid-month convention. For a half-year convention, you have to start the depreciation as if you purchased the asset in the middle of the year. This may reduce the amount of depreciation expense that is in the first year. For a mid-quarter convention, you have to start the depreciation as if you purchased the asset in the middle of the quarter. For the mid-month, I bet you can guess on this one. Yep, you start the depreciation as if you purchased the asset in the middle of the month. These conventions do change the depreciation formulas a bit. We've covered a lot so far. Now let's look at some depreciation schedules. The IRS likes the MACRS schedules, or Modified Accelerated Cost Recovery System. There are other models, including straight line. Here is an example of the MACRS schedule using the half-year convention. The numbers in the table indicate what percentage of the cost you can deduct during the given years. For instance, in the 3-year property column, you can deduct 33% of the cost in the first year, 44.45% of the cost in the second year, 14.81% in the third year, 7.41% in the fourth year. It seems pretty goofy, I know, but that is how this is laid out. And you can see from this that the schedules for the 5 and 7-year property have a similar pattern. They are just smaller percentages, since the cost is spread over longer useful lives. Here is how the 3-year schedule would play out. Suppose you purchased a 3-year asset that was $3,000 plus tax and shipping. The total that you spent was $3,410. You can see here that in the first year, you would take $1,136.55 in depreciation. In the second year, you would take $1,515.75 in depreciation. And in the third year, you would take $505.02 for depreciation. In the fourth year, you would depreciate the remaining amount. Now, we may call this a 3-year asset, but you probably have noticed that it does depreciate over actually 4 years, and that is because of the half-year convention. We had a smaller amount of depreciation done in the first year, and then the length of time gets extended at the end. You will see that with the other schedules as well. Here is how that 5-year schedule would play out. Suppose you purchase a 5-year asset that was $7,000 plus tax and shipping. The total that you spent was $7,740. You see here that in the first year, you would take $1,548 in depreciation. In the second year, you would take $2,476.80 in depreciation. In the third year, you would take $1,486.08 in depreciation. Depreciation expense would be $891.65 in the fourth and fifth years. And in the sixth year, you would depreciate the remaining balance. As I mentioned before, it may be called a 5-year asset, but the depreciation will run over 6 years. From this discussion, you can guess that depreciation in fixed assets can be quite complicated, and it is. To help keep track of this, there are software options for you. If you have an outside accountant or tax preparer taking care of this, they will probably use their own software. And that's great, let them. If you are going to track this, here are some options. There's QuickBooks. They have a fixed asset manager feature. There is Asset Panda, Upkeep, Sage Fixed Assets. You can even use Excel to track it, and you can find their template online. If you have several assets, I do not recommend using Excel. You may find yourself in Excel hell. Now, this was a big topic today. If you feel like throwing up, please pause this video and go take care of business. Feel free to watch this video as many times as necessary. Remember though, that the hard parts are going to be handled by your accountant or your tax preparer. My purpose here is not to help you become an expert in this area, but to give you a good understanding of what's happening with fixed assets and depreciation in that whole process. If you want to read more about what the IRS has to say, I put a link to their website in the description down below. Thank you. This has been Managing Your Business by the Numbers. My name is Randy Helm. Thank you for watching this video. Be sure to look for new videos from me soon. If you liked what you saw, be sure to subscribe to this channel and hit the notification bell so that you do not miss out on any new material. Also, please leave a comment down below if there is a topic you would like me to cover. Until next time, have a good day.